Hey there, fellow investors and curious minds. Welcome to another exciting deep dive into the world of finance. Today, we're going to unpack a strategy that's been making waves in the investment community for decades: growth investing. Now, I know what you're thinking. Oh, great, another boring lecture about stocks and numbers. But hold on to your hats, because we're about to embark on a journey that's anything but dull. Growth investing isn't just about throwing money at the next big thing and hoping it sticks. It's an art form, a delicate dance between risk and reward, and a thrilling roller coaster ride through the ups and downs of the market. Whether you're a seasoned pro or a complete newbie, this video will give you a fresh perspective on how to potentially grow your wealth faster than you can say compound interest. So what exactly is growth investing? Well, imagine you're at a farmer's market. You've got two options: buy a fully grown apple tree that's already producing fruit, or invest in a small sapling that has the potential to become a mighty oak. Growth investing is all about spotting those saplings, companies with huge potential for expansion and increased earnings in the future. Now, you might be wondering, isn't that just gambling? And I'll be honest, it can feel that way sometimes. But here's the kicker: growth investing isn't about blindly throwing darts at a board. It's about doing your homework, understanding market trends, and having the foresight to spot the next big thing before everyone else does. Let's take a trip down memory lane. Back in the late 1990s, a little company called Amazon was just getting started. To most people, it was just an online bookstore. But growth investors saw something more. They saw a company with the potential to revolutionize retail. Fast forward to today, and Amazon is a tech giant worth over $1 trillion. That's the power of growth investing. But here's the thing: for every Amazon, there are dozens of companies that don't make it. Remember Pets.com? No, exactly. That's why growth investing isn't for the faint of heart. It requires a stomach of steel and the ability to weather some serious storms. So, how do you spot a potential growth stock? Well, it's not an exact science, but there are some telltale signs. Look for companies with strong revenue growth, expanding market share, and innovative products or services. Think Tesla in the electric vehicle market, or Netflix in the streaming world. But here's a lesser-known fact that might surprise you. Sometimes, the best growth stocks aren't the flashy tech companies everyone's talking about. They might be boring, under-the-radar businesses that are quietly dominating their niche. For example, did you know that one of the best-performing stocks of the past decade was a company that makes pool supplies? Yep, you read that right. Pool Corporation has returned over 1,000% in the last 10 years. Who knew chlorine tablets could be so profitable? Now, I can already hear some of you saying, but what about value investing? Isn't that safer? And you're not wrong. Value investing, which focuses on buying undervalued stocks, has its merits. But here's a little secret: the line between growth and value investing isn't as clear-cut as you might think. Take Warren Buffett, for example. He's often hailed as the king of value investing. But if you look closely at his portfolio, you'll see plenty of growth stocks. In fact, his biggest holding is Apple, a company that's been a darling of growth investors for years. The lesson here: don't get too hung up on labels. The best investors know how to blend different strategies to maximize their returns. But let's get real for a second. Growth investing isn't all sunshine and rainbows. It comes with its fair share of risks. Growth stocks are often more volatile than their value counterparts. They can soar to dizzying heights one day and come crashing down the next. It's like riding a roller coaster, thrilling, but not for everyone. And here's another thing to keep in mind: growth stocks rarely pay dividends. They're too busy reinvesting their profits back into the business to fuel further growth. So if you're looking for regular income from your investments, growth stocks might not be your cup of tea. But for those willing to take on the risk, the potential rewards can be astronomical. Just ask anyone who invested in Netflix in its early days. A $1,000 investment in Netflix at its IPO in 2002 would be worth over $500,000 today. Now that's what I call growth. Of course, hindsight is 20/20. It's easy to look back and say, "Oh, I should have invested in that." The real challenge is spotting these opportunities before they become obvious. That's where the fun and the potential profit lies in growth investing. So, How do you get started with growth investing? Well, the first step is to do your research. Look for companies with strong fundamentals, innovative products, and a clear path to growth. But don't just rely on financial statements. Keep your ear to the ground. What products are your friends raving about? What new technologies are making waves in your industry? And here's a pro tip. Don't put all your eggs in one basket. Diversification is key in any investment strategy, but it's especially important in growth investing. Spread your investments across different sectors and company sizes. This way, if one of your picks doesn't pan out, you're not left holding the bag. Remember, growth investing is a long-term game. It's not about making a quick buck. It's about identifying companies with the potential for sustained growth over years or even decades. So be patient and don't panic every time the market takes a dip. And speaking of dips, here's something that might surprise you. Market downturns can actually be great opportunities for growth investors. When the market gets spooked, even great companies can see their stock prices tumble. That's your chance to swoop in and grab some bargains. But perhaps the most important thing to remember is this. Growth investing isn't just about numbers on a screen. It's about being part of something bigger. When you invest in a growth company, you're not just buying a stock. You're buying into a vision of the future. You're supporting innovation and progress. And that, my friends, is pretty darn cool. So there you have it, a crash course in growth investing. It's not for everyone, but for those willing to embrace the risk and do their homework, it can be an incredibly rewarding strategy. Whether you're looking to dip your toes in the water or dive in headfirst, I hope this video has given you some food for thought. Before we wrap up, I want to hear from you. What are your thoughts on growth investing? Have you had any success with this strategy? Or maybe you've got some horror stories to share. Drop a comment below and let's get the conversation going. And hey, if you enjoyed this video, don't forget to smash that like button and hit subscribe. Turn on those notifications so you don't miss out on our next deep dive into the fascinating world of finance. Until next time, happy investing.